You're listening to the Real Estate Proverbs Podcast with host Kevin Jefferson. This is the #1 podcast for African American real estate professionals who are doing extraordinary things. It's time to tune in. And now, your host, the People's Lender, Kevin Jefferson.
Welcome to Real Estate Proverbs Podcast. I'm your host, Kevin Jefferson. Today we have a special guest, a gentleman by the name of Marc Welch from CRAM Capital. How you doing, Marc?
Man, I'm doing great. Happy Wednesday.
Happy Wednesday to you too, brother. So Marc, tell us a little bit about you and CRAM Capital.
Well, I've been in the, first of all, I got to give props. I'm an HBCU grad. I went to Kentucky State University in Frankfort, Kentucky, the only historically Black college in the state of Kentucky. We sit on the hill in the state capitol. Actually, the capital is pretty much right down the street from where the university sits. I've been in the lending business since 2002. Started my career with Ascent Home Loans doing refinances and transitioned into countrywide wholesale lending. From there, transitioned into being a net branch owner. And from there, I transitioned into what I'm doing now. So CRAM Capital, we're a nationwide commercial broker. So on the commercial side, we do SBA, USDA, and we also do residential. So anything that's any real estate that is income producing, non-owner occupied, residential, pretty much fall into our category.
Gotcha. So you say you do commercial. What took you from the residential into commercial?
Well, on the residential, I did a lot of hard money, fix and flip, some buy and hold. I wanted a bigger challenge, and plus the money's better.
Hey, say no more.
Yeah, larger loan sizes, dude.
Wow. So you
same amount of work, better reward.
Hey, so hard money. Tell me what hard money is.
Well, hard money is one of those terms that people really get confused by. Hard money is really short-term. It's a short-term lending. So normally you don't have the same requirements if you're going to a bank or into an institution. So it's mostly asset-based. So you may use the money to acquire property quickly, but it's going to be a higher cost because the terms are shorter. So normally it's going to be 6 to 12 months. So 6 to 12 months interest only, and it's a riskier situation for the lender. So most of the time you see higher origination fees, and the rate's going to be in double digits. I personally, when I used to fix and flip, I used to pay 14.99%, but I didn't think anything of it because it was interest only. So if you look at it, I have 12 months at say 15% divided by 12. I was paying 1.25% per month.
Wow.
So if I got the property off my books in 6 months times 6, I've only paid 7.5% because it's interest only.
Wow. So on the commercial side, I guess your competition would be banks.
Really, I don't have any competition per se because I do have relationships with different, mostly with regional and commercial banks, because they may have a deal that don't fit into their box. Like for instance, on the commercial side, we have what they call small balance commercial. And what's the difference between small balance commercial, CMBS, or a bankable loan, or we do a multifamily agency debt, is that you can get it done without tax returns. So you can do a stated loan. So it gives you more options, and or you can do a bank statement, which they call reduced doc. So you give you a little bit more options at the table.
So on the bank statement with very little docs, is that I'm assuming it's solely business bank statements?
Yes.
And
well, sometimes you can do personal. It depends if Because some individuals are sole proprietors. And when you're on the commercial side, some investors create a different entity per transaction. So the entity doesn't have to be seasoned in order to get it done.
Gotcha. So, okay, like you said, you could be a sole proprietor. So if the person is purchasing a property, commercial property, I know with hard money, they typically want it in an LLC or some type of corporation.
Yeah, so that's the title to the property must be in an entity and not in your personal name. But you can use your personal finances. So if you have a retirement account, 401k, IRA, or you have a brokerage account, you can use those funds. So those are considered your liquidity. So you can use those funds to qualify. So as long as you have, say you and your spouse having a joint account. So normally you assume that you have 50% ownership of the funds in that account. And if you need more than the 50%, then your spouse will have to give you permission, or the co-account holder give you permission to use the additional funds.
Gotcha. So I'm looking to purchase a commercial property, and I'm looking for finances. Where would I need to start?
Well, first and foremost, what type of property you're looking at. Commercial is a very broad term. So you get calls of like, yeah, I have a client, agents a call. My client is looking to buy a commercial property. So the first thing I need to find out what type of a commercial property is one, and what's going to be the usage of the property. So I'll give you an example.
So let's say I'm looking for laundromat.
Laundromat. So a laundromat would be considered an owner-occupied commercial property. So you, the owner, will be the one operating that business from that location. So, and then again, are you buying the laundromat and the business, or are you just buying the business?
Okay, let's say I'm buying the laundromat and the business.
Okay, so now a deal like that, to get the best leverage, would normally go SBA, because you can get up to 90% leverage on it. So that would be option number one.
Okay. So what would I need to qualify for an SBA loan?
Well, SBA is similar to like on the residential side. It's going to be a full doc loan, just like you do FHA. Consistent guaranteed by the government. So you're looking at 3 years tax returns. So 3 years business, 3 years personal. But if it's a startup, you're not going to have business returns. So we'll go by your personal returns, and also you have to do if it's a startup business, what's the Proforma on that business, and what is your experience operating a business in that vertical. So you have to have a business plan to go along with it. If you're buying into a franchise, then the franchise have certain documents and training that go along with the acquisition.
Gotcha. So you said something for our listeners who don't know. What's a pro forma?
A pro forma is like your projection for your income and expenses. So on the commercial side, they'll say a pro forma. Well, and when you're doing like say you just need a business loan, they'll say what are your projections. So what you're doing, you're forecasting your income and expenses over 1 year, 2 year, 3 year, 4 year, 5 year period.
Gotcha. So the SBA is full doc, and I can't remember. You said the business doesn't have to have a seasoning period?
No, the business, if it's a startup, if you have a startup business, if it's a startup, then we'll go off of your personal returns. But if it's a startup, then you're going to reduce the leverage because it's a startup. Normally it's going to be around 80 to 85%. But max LTV is contingent on your debt service coverage. Normally it's going to be 1.25 or greater.
So the debt coverage service on the business, correct?
On the business, yes.
Business, gotcha.
When you do your pro forma, you're looking at your income and expenses. So your expenses, your operating expenses is different than your mortgage payment. Mortgage payments is not an operating expense.
True. So for us on the residential side, that's our
On the residential side, you look at it in your DTI, you would put in your
DTI.
DTI.
Yep.
So on the commercial side, you have your gross potential revenue. Then you back out your vacancy and credit loss. Then that's going to give you your gross income. From that, you back out your operating expenses. So under operating expense, you have taxes, insurance, property management, your maintenance reserve, we call what a replacement reserve. Replacement reserve is normally between 250 to 600, and that's kind of like your capex reserve. So you put that aside. It's not cash you have to bring, or you don't spend it each month, but it's what you put into your reserve bucket in case you have a rainy day. You have it there.
Gotcha.
You have property management. You have your marketing. You have landscaping. You have trash removal. But some of those could be a pass through, because if you're in a say a non-SBA loan and you have tenants. So, well, you can have tenants under SBA as well, but say you have a triple net lease where the tenants are paying taxes, insurance. Only thing you're responsible for is the debt service. Then it's like a pass through.
Wow.
Yes.
So on the commercial side, in terms of non-SBA loans, let's say I wanted to do the same thing and it wasn't let's say I'm buying a building, there's a laundromat already involved, but I wouldn't be operating. How does that work?
Well, similar. So now the question is going to be, is the laundromat currently operational, generating income, or if the building vacant? It may be set up for a laundromat, but it's not active. So if it's not active, then you have to do what we call a bridge loan. So the bridge loan allow you to acquire the property and then stabilize it. When they say stabilize it, it means you get it rented and you have 12 months to stabilize your income.
Gotcha.
Yeah.
Gotcha.
So you cannot buy on a long-term debt a vacant commercial property, because you have to have the income help determine the value. So, like, have you ever watched Shark Tank?
Yep, all the time.
Okay. So you see when they come on Shark Tank, a guy will say, "Hey, I'm looking for $100,000 for 10% equity in the company." And Mr. Wonderful, like, do you have any sales? You know, and they're like, "Well, not yet." They say, "So how are you going to value your company at $1 million?" And people be like, "How the heck did they do that so quick?" So all you're doing, you divide the 10% into the equities that they're asking for.
Gotcha.
So same thing. That's where your cap rate comes in. So if you know the net operating income, you divide that by your purchase price or the asking price, and that gives you your cap. Or vice versa, if you know the cap rate and the net operating income, you divide the cap into the net operating income, that give you the estimated value of the property.
Gotcha. So in terms of CRAM Capital, and I understand you've got a great knowledge on the commercial and the SBA loans, man. I knew some, but you taught me something here tonight. In terms of lending, what other type of things do you guys lend on? Do you lend on commercial buildings? Just give us a...
Oh yeah, we office, retail, industrial, hospitality. But we like doing multifamily, restaurants, bars. Like now with COVID, that impacted, across the board. Like pretty much no business went without being impacted, And so we try to focus on those businesses, mom and pops, that probably in a situation. Most commercial loans, another thing you have to look at, like if you go to a community bank, most of their loans are going to be 3 to 5 years. So you have a balloon at the end of that term. And what a balloon, for the audience, a balloon note, meaning that the loan is going to come due. So you either have to refinance it, sell it. You only have 2 choices, because unless you can pay it off in full once it's due. So with the government in short loans, you can have 20, 25-year AM on this as a longer term. So that help out a little bit. And like I said, if you're doing an apartment building, we call agency debt for multifamily. So you have Fannie Mae, Freddie Mac, and you have HUD. HUD has a 35-year AM, 35-year term product. But right now, HUD is taking almost 12 months to close.
Wow.
Yeah. But you normally will do that because you're looking at a larger project. So one of my buddies just closed one of 35 years at 2.16 rate. So, but it's I think it was a $25 million project.
Wow.
So, but everything is based on the vertical. When I say vertical, or the asset type that you have, because each asset type have different risk associated with it. So the way you look at an apartment complex is totally different than how you would look at a restaurant.
So when you're looking at a restaurant, do you need to get a pro forma for that as well, or how's that?
Oh, most definitely, yeah. Because the pro forma is what your income and expenses, or you can a pro forma is your P&L profit and loss statement estimated over a time frame. That's all it is.
Gotcha.
But then you have escalation of your, say, okay, our income is going to increase by 1%, 5%, 3%, 10%. You know how you're going to calculate it out. So you average that in, then your taxes are going to go up based on the millage rate. So you calculate that in when you're doing your projections.
Wow.
So like restaurants are normally have about 97% failure in the first 5 years or less. So it's a riskier model. So when you're doing a restaurant, you really want to see the experience of the operators. Give you an example. I have someone call me with a restaurant opportunity in North Augusta, which is in South Carolina, but right next to I think Aiken, somewhere in there, next to Augusta, Georgia. And the investor is buying a restaurant, but he's not going to be the operator of the restaurant. So because he's not going to be the operator of the restaurant, and with the pandemic, and this is one of those restaurants, is a buffet style restaurant, no one wants to touch it.
Wow.
Because so now with the pandemic, those restaurants who have a drive-through or have delivery, say like Domino's or Marcos, their cash flow was not interrupted. So you have like Cracker Barrel and House of Pancakes, you have to go in and actually sit down and enjoy the meals. It's about the experience. Chick-fil-A lines wrapped around the corner, people still stand in line, hot, cold, rainy, they're gonna get it. But if you have a sit-down restaurant, say Ruth's Chris, it's the experience. You got to go and sit down and look through the menu. So they may offer takeout, but their volume and sales decrease because they're operating outside of their normal realm of business.
So right now, I've rode by probably 5 or 6 Golden Corrals, and I hadn't seen them open since March. I'm not sure if they're going to open.
Yeah, because Golden Corral is a buffet style.
Right.
You have an airborne pathogen. So now you don't want to go to the salad bar and leave with something you didn't come with.
Yeah, man.
So that's the thing, dude. So just trying to understand the business, the different business models. And like when you're doing most restaurant operators best leverage if they go small business administration loan. Like some of the deals I've tried to get done in the past on a restaurant, they want to see, like I had a client, they've been operating at the same location and they wanted to buy the location, but most lenders wanted to have been in business for 5 years before, or have 5 years of experience. So they may not have been at that location. So they were a general manager somewhere else and So because restaurant is so many moving parts that go to the success of it, that it's kind of scrutinized more than some of the other verticals.
Wow. So right now, so what is it? Checkers where they got the walk-up window.
Yeah.
Is somewhere like
it's
that.
Cool because you don't have to go inside.
Right.
So their revenue should not be disrupted. Checkers, Popeyes, you notice since the pandemic, no one's standing in line for that sandwich, huh?
Nah. Nah. But it's weird. I called my wife the other day and I said, "Hun, this is the first time I've ever seen a Taco Bell line the same length as Chick-fil-A because they're right next to each other."
Yeah,
It's because you can't go on the inside
unless they were
giving away free chalupas. I don't know.
You got to ride for the border instead of run for it. Yeah.
Oh, so in terms of like we've talked about commercial, we've talked about SBA loans. Something I wanted you to kind of dig into, and it's a hot button right now, which is Airbnb. I heard that you're the go-to guy for the Airbnb finance, and tell me a little bit about it.
Man, we love Airbnb, dude, because it's one of the hot things going on right now. So, I'm on Clubhouse, and there's so many people that say they became millionaires by Airbnb. A lot of people I've talked to, they do. I guess Airbnb has two structures. You have what they call arbitrage, and arbitrage in layman terms is a wraparound mortgage. Wraparound is not a wraparound mortgage, but a sublease. So you lease the property and then sublease it on the short-term rental platform, whether it's Airbnb. First Key is a Flip Key, Bookings.com or VRBO. I don't operate in that space. I operate in the space where you're actually, because we sell debt. So if you're actually buying the property or you already own the property, you're looking to refinance it. So to qualify, it's similar to doing a long-term rental, but we look at prior to COVID, on the refinancing, we were able to if you've been in business 2 years, we can use the revenue from the platform. And so now, post-COVID, we're still in COVID, post-lockdown, it's no longer done that way. So we're looking at market rent to qualify you. So whatever the market rent is for that area and how that is calculated, when the appraiser goes out, the appraiser will do an income and expense analysis, and they look at similar properties, what they're renting for, so they provide rental comps and arrive at a market rent based on the rental comps. And so we use that to qualify. We're not looking at your personal income. Tax returns are not needed. Pay stubs, W-2s, strictly off the revenue of the property, of the market rent of the property, our potential market rent.
So how much down payment would I have to put down?
That's very best case scenario, 20%.
And I'm assuming it would be titled in the LLC as well?
Will be titled the name of the entity. You will be the guarantor. So you're signing on behalf of the entity.
And the other question would be, as me being the personal guarantor, would it show up on my personal credit?
No, it's not. It's not a consumer debt.
Wow.
Your mortgage is a consumer. Your car loan is a consumer debt. But that's not a consumer debt. But now, if you don't pay
it, you're coming to get me.
If you don't pay it back, it's strong possibilities may pop up.
God.
If you default, then it's a totally different story.
So 20% of the sales price or 20% of the appraisal price?
No, sales price. You know how it works. Appraised value or purchase price, whichever one is lower. It's always going to be the purchase price, whichever one is lower.
Got you.
Yeah. I hope no one is buying a property for $400,000 appraisal $5 and they want they want to take a mortgage for 5 and they can't get none of the equity out. That would be cool.
Well, it's crazy, man, because on my side, I have people ask me, say, well, if I'm approved for 275 and I get a house for 200,000, what happens to the rest of the money?
Not yours.
It's not yours. We don't give $75,000 just because.
Yeah. I have a client that called me. Someone referred them to me, and they're purchasing a commercial building, and they were going through a different lender. They were having a headache getting it done. And they were like, well, I want to get this done without putting anything down. I said, how you want to do that? Oh, well, the last person we were dealing with, I was going to get 60,000 back at closing. I'm like, really? So I politely told her, I said, man, you come off as a very savvy businesswoman. So between you and I, don't repeat that in public again. So you're looking at a year and a day for mortgage fraud, a real estate fraud by doing that. I say, so what I clarified at first, I wanted to know, do you have a master lease agreement, or are you in a lease to own, or are they holding a private mortgage on the property? Is it owner finance? Because under those circumstances, the possibility she has gained the equity in the property. So now we got to treat it as a refinance rather than a purchase. So now you can tap into the equity.
The equity.
But, if you're doing a lease purchase, like when I used to do residential loans, if a person went into a lease purchase agreement at 80K, and when it's time for them to refinance to purchase the property, and the property was appraised at 100, so instead of needing a loan for 100,000, we're doing that at 80% LTV on the refinance. Normally they didn't get the cash out, but this person, I said, well, since that individual going to get you $60,000 back, why do you close to them? Why are you coming to me?
Yeah,
running into 60K. Hey, we gonna get that loan done.
Right, run into the same thing.
They were giving me the runarounds and then da. Yeah, selling you a dream. There's a lot in the. Mm-hmm.
So we're back at it, man.
Okay.
So in terms of CRAM Capital, the CRAM Capital Group, what would you say you guys specialize in? Like, what is your sweet spot? What do you think you do well?
Structured deals. Yeah. We pretty much do everything everybody else does. But it's our understanding of the guidelines and the lending programs that's in the marketplace and how to fit the right investor into the box that's going to maximize their leverage.
And in terms
that's what we do well.
So in terms of type of investors, what type of investors do you typically work with?
I prefer ones that are experienced. Yeah, to be honest, dude, in the past, giving back and helping out the younger investors just coming in, but that eats up a lot of your time, and it's all about turning the deal over and getting to the finish line. So as a lender, I'm not the coach to analyze your deal and say if this is a good investment, it's not a bad investment. That's your decision. You should have a business model already in place of what you're trying to get done. So I find that, I get the old commercial that say educated consumer is our best customer. So I get along better with educated consumers, educated investors. So I would work with newer investors, but I just get more out of. So I like working with individuals who are trying to scale their business. They may have 2 or 3 properties. Now their vision is to get to 10 or 20 or 30. So I can help them grow. I have an investor, when I first started working with him, I had $2 million worth of properties. Now he has like $30 million worth of properties.
How long have you been working with him?
Met him on Craigslist 2014.
Wow.
I have like 5 people like that. Old Craigslist connections.
Wow. That's amazing, man. So
when you understand what someone is trying to accomplish and they'll come back to you, time and time again, because you don't have to put any agreements in place, and then when it's time for you to get compensated, it's like people become amnesia, like, "Oh, you didn't earn that fee," like, huh? So they don't. Some don't respect what you do, and when a person understands the landscape, you get requests. Well, I want to do something creative. Well, explain to me what is creative. What are you trying to do? And that's a very broad term. What do you mean creative financing? Well, I want to get a business line. I want to get financing in my tax ID name. I'm like, okay. Your tax and your EIN. You want to buy a property? Yeah. Well, I can't help you with that. But so-and-so said we can do it. I like, well, go to so-and-so. But I'm not saying I know everything, but I've been in the lending business for a while, and I have not yet came across anyone that provide a mortgage with the tax ID. Now you do have, on the residential side, you have the tax identification number for foreign nationals. But I have not seen someone use, that's a U.S. citizen, you can buy an EIN number.
Yeah, it's a big misconception.
Yeah.
I even get it on the residential side that people want to buy properties in the business name, and we don't do it.
Especially on the residential side, because you're buying, and that's the thing with, I have to tell, like now with Airbnb, there's a big thing people are doing now called property hack, which is one of the oldest strategies known to man. You have a property and you rent out a room to someone else, and the income that you get from renting that room or that space help wipe out, your debt. So if you have 3 roommates paying you $1,500 in mortgages, $1,000, then you have a surplus of $500. But now they call it property hacking. So everyone want to do it. They even want to do it with Airbnb. But with the loans that we do, since we don't fall under Dodd-Frank, you can't live on property at all. And when you close, you're going to sign disclosure saying that this is my primary residence, or this is an investment property. I will not be living at the residence. So any violation of that, we get. If I knowingly put someone in the property, knowing that they're going to live there, that's a huge fine on my end, and I'm not going to pay that fine. So I only do non-owner occupied properties.
What's the minimum loan amount for you on someone who wants to get an Airbnb?
I try not to go under 200K.
And you'll do a single unit?
Oh yeah, we do 1 through 4.
1 through 4.
So condos, single family, townhomes, duplex, triplex, quads. Up north they call them flats. 1 family flat, 2 family flat, 3 family flat. But in the East Coast, the row houses. So we get those done.
Right.
But before we got started, I was sending an email, got a request from someone in the Poconos buying a property. And up in Tennessee, we do log cabins as well. I've done log cabins in Washington State and Oregon.
Do you just lend in the 50 states in the United States, or do you go
mostly all the mainland states? I don't. Puerto Rico and BI, I have not lent in those states, but and I can lend in Alaska and Hawaii. I've lent in Hawaii. I've never lent in Alaska.
Wow.
Yeah.
Wow. So
Hawaii is a totally different beast, though. The cost of living there is on a different level.
Wow. Yeah, I've never been. I can imagine it being on a different level. So
long plane ride, dude. I've been there before. It's a long plane ride. Over water. You over water for like 7 hours.
Wow.
Yeah.
Wow. Well,
so anything happens, you already just
you gone, huh?
It's a long way to find. Let's swim back to California. Tell you that.
Wow. So, has anyone ever come to you to try to do Airbnb on like a new construction where they built from ground up?
Oh yeah, yes. We doing a couple in up in Tennessee right now, in Gatlinburg and Pigeon Forge.
Wow.
Yeah.
That's and something else that I had a question about that I know a little bit about. Storage container homes. Do you guys finance on those?
No, I've never done one of those. Yeah, I've never done one of those.
Yeah, one.
I've heard people talk about it. I tell me personally, I grew up in an impoverished area of Miami, and they know in the world I'm living in a storage container. I'm not living in a storage container, or what they call it, the
tiny homes.
The tiny homes. Now I'm too big for a tiny home. Yeah, I can't. No. Wow. I gotta have some space. Can't do it. But I'm familiar with the storage container. I had a guy that approached us about 5 years ago in Maryland, and at the time there wasn't a market for it. And he was saying the cost of construction for him was going to be like 60 to 80K, and end sales going to be like 450 to 500. Don't know whatever happened to him, but I just stick with the traditional. Sometimes you got to stick to a low hanging fruit, because you can turn your wheels and lose valuable time trying to find a home for a loan that's not within your wheelhouse. So, like, I have the ability to do new construction, and fix and flip, but I try not to do them unless there's other components attached to it.
Meaning?
Like, say, if it's a fixed to rent, so they're fixing it up to rent it, cool, it's going to be a cash flowing property. And so, like the ones at Airbnb, the reason for building it is to rent it out. So, and if I'm doing fix and flip, it's normally going to be for I'm putting someone on a line of credit and they're scaling their business. So the line of credit is like a guardian line. So it's securitized or collateralized by the real estate that you're purchasing, or the real estate that you're refinancing on it. And it's for renovation loans. But on that, you can get up to 7 to 10 times your liquidity. So if you have $200,000, you're looking at $1.4 million. So if you have 200K and you were doing, I have a guy that's started from Clubhouse yesterday, as a matter of fact. He has a property in Miami that he built from ground up. Property's worth $500K, and he has tenants in it, but he used his cash, $250, to build the property. And now he has other opportunities he can't take advantage of because he doesn't have any cash. He got to get out of this property in order to get the cash. So we're going to do a refinance for him. So now he's going to get about, I think he's looking at around 3 and some change liquid. So now he has good experience. I'm going to get him a line of credit. Now he's going to be like, say, $2.1 million line of credit. And now he can run several projects at one time because he has the liquidity to do for the debt service on it.
Gotcha. So
what the line of credit do is it help an investor scale more aggressively and increase their leverage position.
So how does that work in terms of the line of credit? When they see a property, they just can write a check, or is there a process?
Oh, no, it's not. It's a great question. It's not like a home equity line that you guys may be used to. A guardian line has a specific use. It's for real estate only. So each property you take down has to meet the criteria for that line. So you're buying a property, say minimum loan amount on the line, say, is 100K. And so you find a property for 100K, 50K in rental, rates of 200. So and it's short term, 12 months. Then you have to refinance off into a long term debt or sell the property.
Gotcha. So Marc,
it's designed to help you become more aggressive and scale your business.
Gotcha. So, man, I don't want to take up all of your time. I definitely know we could keep talking because I've got a million questions. But if someone wants to reach out to you and see about if they're qualified for financing through CRAM Capital Group, how can they reach you?
You can go to our website, cramcapital.com, or you can call the office at 470-447-2077, or you can shoot us an email to info@cram, KRAMCAPITAL.com. That's the thing with CRAM. Some people spell it with a C, but it's spelled with a K. So don't get it confused with cranberry juice.
And what about your social media?
Our Facebook is not where it needs to be yet. But you can look us up on look me up on the Clubhouse. I'm in the house. I created an Instagram page, dude. I was on Clubhouse. They're like, dude, no one know how to get in contact with you. They're like, well, I can give you this. They know you got to get an Instagram. So while I'm talking, I created a quick Instagram page.
Wow.
And that's the only thing I use it for. But now I'm thinking outside the box because trying to get I have a digital marketing team that's redoing our website and working on our digital marketing campaign. So I'm looking for someone to do the social media, like the bios and, the optimization of that so we can get better exposure.
Gotcha.
Yeah, I was on Fiverr last night, communicating with people, trying to line something up.
Cool, man.
Yeah.
Cool. Well, man, thanks for your time. We appreciate it. If you like this podcast, please like, subscribe, share, and comment. And I'm your host, Kevin Jefferson. Have a great day.